It's no secret that the cost of living has drastically ramped up here in Canada over the past couple of years, with Canadians still feeling the pressure of rising prices on everything from housing to groceries, vehicles. Basically, every facet of the market has seen lasting price increases, except somehow IKEA dropping prices on a bunch of their items. But this inflationary trend has made it increasingly difficult for millions of Canadians to now cover their monthly expenses with current income levels, forcing many to make tough financial compromises and cut back on essential expenses, which is maintaining the countrywide worried narrative that income is having a hard time keeping up with the cost of living. Hey, what's going on everyone? It's Griffin here, and it's been a while since I've made a market update video covering the many corners of Canada's financial and economic system, and so I felt it time to jump back in to see how Canadians are faring under current events, along with analyzing key trends and developments that could affect our financial landscape in the coming months. So let's get into it, and quickly here before we really dive in, a quick word about today's video sponsor, moomoo's current 6% promotional interest rate on the idle cash that's just sitting in your account, which is above their fantastic bonuses, including a $2,000 commission-free trading card to avoid $2,000 worth of commission fees, free level 2 market data, and a $200 cash voucher if you deposit $2,000 into your account using my link down below in this video's description. So a really easy way to earn 6% APY on your cash holdings before investing in your moomoo account. All right, so with that covered, let's talk about the current state of Canada's economy. Canada is currently facing a variety of economic issues that are impacting households across most income brackets, even despite inflation levels now dropping down to a more manageable level of around 2.7% as of June of this year, which is one of the primary reasons why the Bank of Canada proceeded with their first interest rate cut in nearly 4 years as of last month, dropping the underlying rate to 4.75% down from 5%. And we have an upcoming rate announcement in July as of next week. So we'll see if the Bank of Canada ends up slashing rates by 0.25% again. Now let's keep in mind that despite the inflationary peak of above 8% hit in mid-2022, the price of consumer goods remains way above those of only a couple of years back, as a 2.7 or 2.8% inflation rate still indicates positive price growth, albeit yes at a slower pace, but so we're not headed towards lower cost of living anytime soon. So where does this leave the average Canadian's finances in July 2024? Well, TransUnion Canada's Consumer Pulse study for Q2 of 2024 revealed that 57% of Canadian households reported their incomes are lagging behind the current inflation rate, with 38% of respondents anticipating that their bill and loan payments are going to rise in the next 3 months, putting additional upwards pressure on monthly budgets, which has prompted shifts in saving patterns, with some respondents indicating that they are now attempting to save more in their emergency fund while also having to increase their usage of available credit or adjusting their retirement savings plans accordingly. Now, despite this information though, according to Statistics Canada, in the first quarter of the year, the household savings rate climbed to 6.9%, which happens to be the highest level that we've seen since Q1 of 2022, as disposable income has increased by 1.8%, surprisingly outpacing the 1.2% rise in nominal consumption expenditure, where the income growth has primarily stemmed from wages and net investment income, which has seen a robust 4% growth in Q1 2024 thanks to widespread gains from interest-bearing instruments and dividends. That's why it's so important to try and invest if possible. And quickly back to TransUnion's study of 1,000 Canadian adults conducted from May 1st to 10th of 2024, 46% of Canadian respondents say that their household finances are worse than expected this year, which is a 4% increase from last year, and is despite nearly 80% of respondents reporting that their income has either remained the same or increased over the past 3 months. So basically, a growing number of Canadians are feeling financially strapped right now and believe that this sentiment will only get worse over the next few months, which is of course being felt across the economy that isn't seeing a competitive growth trajectory. Additionally, higher interest rates also impact impact the economy as a whole. Canadian economic growth has essentially stalled since the middle of 2023 as consumers have cut back their spending and businesses have also pulled back on investment. Canada's Q4 2023 real GDP growth only saw a 0.02% growth rate, and Q1 2024 only saw a 0.41% growth rate, which is in stark contrast to the United States' 3.4% and 1.4% growth rates over these same periods. In fact, Canada's GDP growth since the pandemic has been lackluster at best and severely behind most other countries in the G7, making Canada slip further down in regards to international presence and competitiveness. So far, the Canadian economy has avoided an outright recession, which is great, of course, but the Bank of Canada had expected economic activity to remain weak through the first half of 2024 before slowly picking up in the second half of the year and into 2025. So we'll see how that ends up playing out. Hey, by the way, in the current market, considering where interest rates are at right now, utilizing a high interest savings account or other financial vehicle that will generate interest on your cash holdings, or instruments like money market ETFs, all of which we covered in one of my recent videos, could be a great option for you to, at the very least, earn some income on your cash holdings and hedge against the current inflationary environment, which is where moomoo comes into play as one of Canada's best discount stock brokerages that offers you tremendous insight and value at zero extra cost, such as free access to level 2 market data provided by NASDAQ, which costs upwards of $80 per month on other platforms, free Morningstar ratings and analysis reports, rock bottom currency conversion fees, as well as unique ways to discover and analyze individual stocks or ETFs. Moomoo enhances its product offering with complimentary access to Morningstar's well-known research reports, as well, enriching the investment experience with comprehensive insights into various financial instruments, where Morningstar, renowned for its in-depth analysis and insightful ratings, stands as a pillar in the financial industry, trusted for assessing the quality and potential of investments. Now, for investors unfamiliar with Morningstar, the platform provides detailed reports and ratings covering a wide spectrum of investments, including stocks, bonds, and mutual funds, as well as exchange-traded funds. And these reports are really invaluable tools for making informed decisions in this complex world of investing. So having that at your fingertips for no extra cost is fantastic. What's more is that Morningstar's star ratings integrated directly into moomoo are a cornerstone to their reports, ranging from 1 to 5 stars, with a 5-star rating simplifying top-tier investment potential, reflecting strong historical performance, current asset positions, as well as potential promising future prospects. And this rating system essentially helps investors compare and prioritize investment opportunities based on risk and return profiles, among other factors. Now, beyond star ratings though, Morningstar's reports offer deep dives into fundamental analysis of individual companies and funds. So they examine business outlook, fair valuations, as well as certain methodologies that are underpinning their ratings in question, where this is aimed at offering investors a level of transparency to better understand why certain investments receive higher ratings than others and how these ratings are actually aligning with their own investment objectives. Additionally, moomoo also leverages Morningstar's research to further provide users with clear, concise, and actionable insights for their investing, with visual charts within the reports simplifying complex data, enabling investors to quickly grasp key information such as price trends and potential buying opportunities during market dips. And this visual representation is particularly beneficial for novice or just newer investors who seek to navigate the financial markets effectively, especially during complicated times like we're currently experiencing. So whether or not you're exploring new investment opportunities or refining existing strategies, users can further leverage moomoo to access and utilize Morningstar's comprehensive research tools very effectively, once again, all at zero cost. cost. Now, in addition to Morningstar's research functionalities baked into moomoo, they also offer features like the ETF style box developed by Morningstar as well, which essentially categorizes ETFs based on size and investment style, which is a tool that provides investors with a visual representation of an ETF's characteristics, as they're all very different, and this is aimed at aiding in portfolio diversification and risk management strategies. Finally, right now moomoo is offering a 6% APY on your funds held within their account under $10,000 for 60 days, along with a consistent 2% per year APY on funds exceeding $10,000. So deposit any amount to start earning 6% APY today, and when you register using my link down below in this video's description, you'll receive up to $2,000 in commission rebate cards and free level 2 quotes. Okay, let's now speak about the state of the housing and rental market, which impacts nearly every Canadian above the age of 18. Okay, so it stands to mention that Canada very much remains in a state of housing crisis as property prices remain high, rents continue to increase as demand continues to climb, all of which while supply and new housing starts remain much lower than they need to be considering population growth in most metro areas. In fact, looking at the Canadian housing market report conducted by Wawa, we can see that the average sold price remains at just below $700,000, which is a bleak reality for aspiring homeowners as prices have not come much off of their peak despite interest rates having climbed to roughly 5%, making affordability even more difficult than at the beginning of the pandemic when home prices were soaring. And the difficulties become even more prevalent in the renters market, as rents for all types of residential properties in Canada rose by 7% over the past year, reaching an average of $2,185 in June, even though this marks the lowest annual growth rate in 13 months, which is hard to believe. Of course, the priciest monthly rents remain in the Vancouver and Toronto areas, but that doesn't mean cost of rent hasn't majorly disrupted household budgets across the country, with many markets seeing double-digit growth figures year over year, which is leading many newcomers to the country starting to consider leaving altogether as the cost of living is just too high. According to a recent poll conducted by the Angus Reid Institute, almost 40% of recent immigrants to Canada are now actually contemplating relocating to either another province or even leaving the country altogether because of challenges with housing affordability mainly. In fact, nearly 4 in 10 immigrants who have arrived in Canada within the past decade are contemplating a move, with a quarter of them pointing to housing costs as the primary reason. Other cite factors such as seeking a better quality of life, the overall just cost of living, access to healthcare, and proximity to family, all of which are quite prevalent issues in Canada right now. Now, the poll also highlights that 28% of Canadians are considering leaving their current province of residence due to the steep rise in housing expenses in, Ontario and BC, where this sentiment is particularly strong. In Ontario, 39% of respondents, and British Columbia, 36%, where housing costs have been notably high for an extended period of time compared to other regions. And despite all of this, Canada maintains an annual immigration target of approximately 500,000 people right now, being one of the highest per capita in the world, with numbers having exceeded 1 million in 2023, which has no doubt exacerbated the issue at hand, despite our need for immigration to maintain population and economic growth. So it's really a tricky situation. And unfortunately, this isn't an issue that has any clear path towards solving anytime soon. That being said, one of the best things that you can do to maintain a hedge against inflation and saving towards the possibility of purchasing a home is to maintain a clear saving and investing plan that you're able to stick to and modify as time goes on. If you're interested in doing that, I'd highly recommend that you check out my link to my free Skillshare course, also down below in this video's description, where you can get access to over 7.5 hours of on-demand free content about how to invest in the stock market if that's something you're interested in. It has over 2,500 students and 7 hours of video content. So thanks a lot for watching. If you enjoyed today's video, please take a second to leave a like. And if you want to learn more about where to get the highest interest rate return in this market, then make sure to check out this video right here. Thanks. See you in the next one.